Welcome to the third video for Chapter 4. Let's look at Freeport-McMoRan Copper and Gold equity section of the balance sheet. We can see that the company has two types of stock, preferred and common. We can also see their main parameters. Preferred stock will receive 6.75% on the par as a dividend, that is, if dividend is declared. 29 shares were issued and outstanding in 2009. In 2010, there were no preferred shares issued or outstanding. Common stock has a 10-cent par value. 1,067,000,000 shares were issued in 2010 and 981 million shares were issued in 2009. We can tell that new issuance was completed in 2010 because of the increase in number of shares. The balance in the common stock will be determined as the number of issued shares are multiplied by the par. So the $107 million balance is computed as 10 cents is multiplied by 1,067,000,000 shares. We can see that capital in excess of par, or the amount paid beyond the 10 cents, is $18,751,000,000. The amount of the total investment will be the sum of the common stock and the capital in excess of par value account balances. We can see that they have accumulated deficit of $2,590,000,000. The previous year they also had a deficit for almost double the 2010 amount. They have accumulated other comprehensive loss, or $323 million, and they have treasury stock. Note how treasury stock is presented as a negative number, or it would decrease equity. The company also discloses the number of shares in treasury, or 122 million shares. This way we can calculate the outstanding shares as we subtract 122 million treasury shares from the 1,067,000,000 shares issued. In this format of the statement of stockholders' equity, we can see all equity accounts and information related to them. The print is a little small and you can see the same information on page 98 of your text. We can see the beginning balances of the preferred stock, common stock, capital paid in excess of par, treasury stock, and how these balances changed from December 31st, 2009 to December 31st, 2010. Similarities and differences between GAAP and IFRS. The accounting for the issuance of shares and purchase of treasury stock are similar. The accounting for declaration and payment of dividends and the accounting for stock splits are similar. Major differences relate to terminology, introduction of concepts, and presentation of the stockholders' equity information. Both IFRS and GAAP use the term retained earnings. However, IFRS relies on the term reserve for other types of equity transactions, which GAAP accounts for in accumulated other comprehensive income or loss. The following ratios are useful when analyzing the statement. Return on equity is computed as net income is divided by stockholders' equity. The ratio measures how efficiently a company uses its equity to produce revenue. We can see that the return on equity for McMoRan has improved. In 2008 was negative, not good, and in 2010 was 44.3%, a drastic increase from 2008 and good improvement from 2009. Financial leverage ratio is computed as total assets is divided by stockholders' equity. The ratio measures how debt can improve return on assets to increase return on equity. A high debt ratio increases the financial risk, but can also enhance profits. The idea is that since debt interest payments are fixed, they don't increase with increase in profits, that would provide a greater amount of profits available for the stockholders. Or with little can achieve a lot. It magnifies. We can see that the financial leverage for 2008 was 4.05, in 2009 was 2.85, and in 2010 was 2.34. The greater the leverage, the greater the magnitude. Unfortunately, that goes for good or bad. Times interest earn ratio is computed as operating income is divided by interest expense. The ratio measures the company's ability to pay its interest payments. As benchmark, you can use 4 or more as a favorable ratio. For McMoran, the times interest earned in 2010 was 19.63. Based on our benchmark, this is a very good ratio, and it's a definite improvement for the last 2 years. Earnings per share is computed as net income minus preferred dividends is divided by average number of common shares outstanding. Earnings per share is the amount of net income earned by each share of common stock. If the company has preferred stock, we have to subtract the dividend that they need to receive from the available net income. If the company does not have preferred stock, that second part of the numerator would be unnecessary, or zero. Companies report two figures for earnings per share, basic and diluted. Basic reflects only the actual average number of common stock outstanding. The diluted increases the actual number by any shares that may be converted to common shares, such as stock options, convertible debt, or convertible preferred stock. Dividend rate is computed as annual common stock dividend is divided by average number of common shares outstanding. The ratio calculates the dividend per share. Frequently, this information is disclosed on the body of the income statement, the statement of shareholders' equity, or in the notes of the annual report. Price-earnings ratio is computed as market price per share is divided by earnings per share. The ratio measures how the market price compares to the earnings per share, or how expensive a stock is. As a benchmark, you can use 15 or less as a favorable ratio. Some people use 20. So if a stock has price-earning ratio of 15 or 20 or more, then you will consider the stock to be expensive.